Good afternoon. Welcome to Digital Look TV. We have today with us Craig Erlam from Alpari and Ishaq Siddiqi from ETX Capital. Thank you very much for joining us today.
Thank you.
Cheers.
Thank you.
Ishaq, let's start with you, for example.
Sure.
Talking about remarks yesterday from Jens Wiedmann, who is the president. He is the president of the German Bundesbank.
Yep.
He told the Wall Street Journal that conceivably the ECB could yet lower rates if the economy weakens. Also, interestingly, he pointed out that the Eurozone might be facing a lost decade. What are your thoughts on this?
Yeah, I think the comments were interesting, especially considering that Wiedmann is essentially at the heart of Merkel's government. He's for the ECB. I mean, he's seen as a hawk, and when it comes to what he said and the effect on the euro, we saw the euro losing a lot of ground against its rivals. When it comes to the lost decade, is it really a lost decade for the Eurozone? I think possibly there is some truth to that. I think we're going to really have to see the situation in the Eurozone crisis. It's still going unabated. The European policymakers haven't really addressed the issue. We may have seen the worst of the crisis over, but again, we've had a Cypriot bailout recently. A lot of worries are now on Slovenia as a country and its banking system. Political paralysis in Italy, we still don't know what's going to happen there. We've recently seen that the Italians have not been able to vote through a president, and in general, although Spain, it seems like it's on track with its budget deficit plans.
So it seems.
So it seems.
Okay. As far as precise levels for the euro dollar for the next couple of weeks, I know, for example, Karen Jones at Commerzbank, she was talking recently about the euro dollar continuing to fall from current levels. However, I also know some other FX analysts who are saying no, the euro dollar will trade up towards 134, 135, and then reinitiate its downtrend. Would you agree with that outlook, more or less?
I think in terms of the trading range, we're going to see it there's good support at 130. Between 130 and 132 is that range that we're going to continue seeing for the next at least 3 months. Craig, how would you view?
I mean, if I'm looking at the charts right now, I can see that for one, there's a big Fibonacci retracement on there. You've got this year's highs to this year's lows, where the 50 fib level, I think, it's around 133, maybe 134, or maybe even a little bit higher, around 136. So I do think we are going to see some more rallying in the euro dollar. I think we're going to see it push that little bit higher. In the longer term, again, if you take a look at the weekly chart, you can see there's a head and shoulders formed, and it's a perfect head and shoulders. It's textbook. So if we do see that rally up to 133, 134, I'm not saying it's going to happen in the next week or 2 weeks, but say over the next 12 months, once we start to see it pull back, then you're going to have a very, very interesting support, and I think maybe around 129, and that's going to be a massive support level then, because if you see that broken, then you're looking at a break towards 119, 120, which is where we saw it fall to back in summer. But I think Ishaq's right. I think for now we could see it in a range.
I think the euro has shown great character, considering the headwinds that we're facing and the uncertainty in Europe now, and as a currency, it obviously suggests that there is enough confidence within the investor world that they still continue seeing the euro, the single currency, as something that they can still make a return on. Whether we continue seeing the upside momentum in the euro, that remains to be seen. I think that 132 level is going to be key. If we can push past that, then it's likely that we are going to see a stronger move towards 134.
Everybody always talks or tries to think in terms of what could push the euro higher. In terms of what could push it lower, if the Italians can't sort out their situation, new elections, Beppe Grillo throws a spanner in the works, it really all just goes worse. Fine, the ECB lowering interest rates doesn't help a lot, but in such a situation, perhaps we could see the dollar strengthen very strongly. Would you think that's possible?
I think it's harder to find what's going to push the euro higher than necessarily what's going to push the euro lower. You can talk about the Italian elections, we can talk about Cypriot bailout, we can talk about Slovenia potentially being the next bailout. We can talk about further issues in Spain. I don't think people have really moved away from the idea yet that Spain are going to get a bailout towards the end of this year. I mean, I think they're really now holding off for these German elections before they start to discuss a larger bailout. I think Cyprus was absolutely necessarily, they prefer to have avoided it, but I think that was absolutely necessary and just had to happen. But I think they're trying to really push things off now till after that German election in September. And even that's not going to be straightforward. I mean, there's talk now that there's another party forming that want anti-euro, anti-austerity. And if you really look at it, the only votes that they're going to steal here is going to be from Angela Merkel's CDU party. So again, I don't think that German election is going to be as straightforward. And so there's problems in Germany as well. And then you've even got France. I mean, the figures that we're seeing out of France at the moment are absolutely terrible. We're seeing that the evidence that they're losing competitiveness, they're not undergoing the reforms that we're seeing and the austerity that we're necessarily seeing in Spain and Italy. I mean, I think the recent PMIs for services and manufacturing for the last 3 months for France have been worse than that of Italy and Spain, which shows that these sectors are contracting at an even faster rate. So I think it's a lot easier to find reasons for the euro heading south rather than what's going to prop it up. I think the only thing that's really propping it up now maybe is technicals. I think there's technical levels which people want to hit before they sell again.
Okay, also just to hit the nail on the head, one thing you were saying earlier, for the inverted head and shoulders pattern in the euro dollar,
Yep.
the neckline,
Oh, it's head and shoulders.
head and shoulders.
Yep, so it's if it breaks the neckline, then
129?
I think it's 129 on the neckline, and then once you see that broken, I think we're going to see a very
So there you have it.
large move
129
south.
is the neckline on the euro dollar. We want to watch that. Yes?
Yeah, absolutely.
Okay. Changing a little bit from geographical areas. Australian dollar. I'm told that you're quite bearish on the Australian dollar.
Potentially, I think again, there's two reasons why. There's one technical and one fundamental reason. You've got the fundamentals, which is the Australia are very heavily reliant on the Chinese economy, and the recent figures that we've seen out of China suggest that maybe it's not undergoing the return to growth that we were expecting. Obviously, China's got growth that any other country in the world would love, but the fact that they was expecting growth of 8% came in at 7.7%. We're also seeing other areas where the economic data is starting to deteriorate, and therefore whenever we've seen anything negative to do with China, we tend to see that reflected in the Australian dollar as well. And like I say, we saw that bad data last week. We've also seen the fact that I think people's expectations for China are just too high. People are talking about 8%, 8.5%. In China, the growth figures, the growth forecast for this year are for 7.5%, and people are just ignoring that because I think people are overly optimistic, and we're almost setting ourselves up for a big fall. We're massively overestimating what type of figures we should expect out of China, and as a result of that, I think we're just setting ourselves up for disappointment down the line. And like I say, anything negative for China is negative for the Australian dollar as well. But then on a technical level as well, we've also got a head and shoulders on here as well. I'm trying to think of the level where that. I think we've got the head at 106. I think the shoulders is around 103. I think the neckline's around 103. But if we see this neckline broken again, maybe in the next few weeks, then that should prompt a move back to parity. So back to around 1.00. But again, technically it is reliant on that neckline being broken, which at the moment is providing a bit of support.
Okay. Thinking about correlations, we have the euro dollar, head and shoulders, Australian dollar, head and shoulders. It seems too much to be a coincidence. Lately, they're talking about the correlations between gold and industrial metals breaking down because people are moving to other asset classes. You were telling me about this before. What are your thoughts on that issue?
Yeah, I think we are seeing a rotation. We are seeing asset allocators move out of your traditional defensives and going into your more risk plays. Particularly equities now, we've seen that. The euro and commodity-linked currencies, metals particularly, although we have seen a massive dip in gold prices over the past few days. I think in terms of metals as a whole, China, again, one of the big key drivers of being the biggest consumer of metals in the world. It's going to be a key driver of base metal prices for the near term. I think we're going to continue seeing that shift from based on investor sentiment, going out into more risky plays as opposed to defensives, and what that means for the global economic recovery. It would obviously suggest that investors are feeling a lot more confident on a longer-term perspective, and although we're going to see a bout of short-term volatility, I think a lot of people in the market right now feel that they can book some decent returns by the end of the year.
Okay. Do you have a favorite asset class?
Personally, I like equities. I emerging market equities are great.
Where would you tell your father to invest his money?
My father? You normally ask me this question. I generally tend to tell him to stick at companies, mining companies, mostly linked to China's growth. I still continue to see China as its growth is going to flourish this year. We are obviously seeing a bit of a blip in Chinese growth, but I do think that we're going to see a regaining strength in the Chinese economy. And for that reason, anything to do with any companies that have heavy exposure to China and metals, resource plays, and any sort of company that has a strong link to the US recovery as well, particularly construction and housing plays, are pretty good areas to be in right now.
Okay. Craig, you were telling me before, there's a debate now. Has gold simply seen a correction, or are we seeing an inflection point in the long-term trend?
Well, I think, for one, I think the shorter-term trend has been bearish anyway. I mean, people are talking about we've seen this drop below that level. I think it was 15.20, and therefore we've seen a big sell-off, and it's almost changed the trend. But the recent trend has been bearish anyway. If you take a look at the charts, we're seeing those lower highs, which is suggest we just had that big support level around 15.20. But again, people are looking for reasons why we've seen a break below that 15.20, and you see so many different reasons. We've seen everything from ETFs reducing their gold exposure to stories of Cyprus selling $400 million worth of gold. That may have pushed it through to conspiracies about it's the Fed that are causing this drop in gold. But I think the most important thing is that it doesn't matter why that level was broken. The simple fact of the matter is, once that level's broken, there was always going to be a huge sell-off. You'll have had a number of stops held right just below that 15.20 level, which will have sparked a lot of selling. And I think that's what you saw. You see it exacerbated by a number of things which pull it down to, I think it was around 1,300 in the end. But that 1,300 is a massive level now, and you could see it solid support here, because that's I think it's the 50% retracement of 2008 lows to 2011 highs. So that's a very big support level. If we saw it break below there, you'd be looking at around 1150, which is a 61.8 retracement. But I now think we're going to see a bit of a correction. I think what we're seeing now is the correction. We're looking firstly at 1420, I think it's a significant level, and then we could even see it push as high as 1520, maybe retesting that previous support level. But I think in the shorter term, it's going to remain quite bearish. In my opinion, I think it won't go any higher than 1420, maybe pull off a bit again. But then you were talking before about how it's becoming more in line with the other commodities. And I think what we're seeing here is, again, once we saw that level broken, people were desperate to sell, because we know that the Federal Reserve quantitative easing isn't going to last forever. And the fact that, and people know it could even come as early as the end of this year. So I think that people have almost been waiting for that opportunity to sell below that level. So I think we're going to see a little bit of weakness, maybe it's still in the shorter term, but then 12 months, 24 months down the line, when we start to see a recovery in the global economy, when we start to see China picking up, and once it does fall back in sync with the other commodities, then it's going to be all up again from there. Maybe not reaching those highs that it was at last year anytime soon, but I think it's going to be bullish in the longer term.
Okay. The Federal Reserve is not going to ease policy further. However, the Bank of England, we had the minutes out last Wednesday. We had an employment report, weakest real weekly earnings since 2001. A small uptick in the unemployment rate. But there are some people who have been fascinated by the fact that employment does not fall in the UK. So they've been waiting precisely for this kind of data. Is it a soft patch? Is it something more? The Bank of England will have to react? Your thoughts?
Yeah, I think it's the UK jobs market has been very interesting to watch over the last few months, because it's been extremely resilient compared to other parts of UK economic activity. We've seen such a patchy run of data coming out from the industrial production side to manufacturing and construction, and this time around we have seen a poor report. I think what it means for QE, for more quantitative easing for the Bank of England, they're still very much divided. I don't think we're going to see any action until Carney comes in, Mark Carney, in July. I think Mervyn King is although he wants more QE, he's on the board for additional stimulus. At the moment, I think there's just enough out there for the Bank of England to just go, okay, we'll still wait and see. The UK economic environment is still very fragile, it's still very shaky, but nothing to really de-stress the central bankers at the moment for them to start pumping an immediate release of QE.
I think the other problem as well, though, is the fact that there's not really any evidence that QE works. Has been working in the UK or has worked for a long time now, and I think that's why they've got those 6 members who continue to vote against it, no matter how much pressure Mervyn King and the other 2 members put on.
Miles, yeah.
Exactly, because I just don't think there's enough evidence to suggest that it's working now, and I think people know that we need a new approach, and I think that's why it's going to be, like you say, July before we see any change, and I don't think it's going to be additional QE at that point. I think we're going to see we're going to see them put a date on when interest rates will start to rise again. Some more unconventional measures that we haven't seen from the Bank of England right now, because the evidence really isn't there that more QE stimulates the economy. And then you've got the other issue, which is inflation's at 2.8%, wage growth is at or below 1%. So you're just exacerbating the problem. Fair enough, you think you may create more jobs, but like you say, unemployment's not great, but it's not necessarily bad now. I think the problem is that people who are working do feel poorer, and I think you've got to think of these issues as well. You've got to think about the fact that people's lives are difficult. Oil prices are coming down slightly, but people are still suffering from these higher oil prices. You've still got food prices, etc., going higher, and I think that has to be taken into consideration. And I think that's why there's so much reluctance among most members of the Bank of England to agree to any further easing.
So no more QE, but yes, possibly alternative measures if the economy weakens a little bit.
I think whether the economy weakens I think once Mark Carney comes in the first 3 months, we'll see something.
Well, the Bank of England will have to employ further unorthodox and unconventional measures. I still think that there may be a cause for an additional bout of QE as a last shot. But I think Carney will definitely change the policy. He will be a lot more accommodative towards central bank easing measures, but perhaps not the bouts of QE that we've seen recently. On just briefly on the topic of the jobs market in the UK, I've felt that on some respect for UK corporates, the corporate sector has done fantastically over the last 2 years, and I think with UK companies they've done a very good job in deleveraging, in streamlining their businesses, and although we've seen a number of layoffs, in general it seems like UK companies are doing far better than a lot of their competitors in Europe, and the revenues and the profits that they've been beating on, especially even now with some of the earnings that we've seen in the last 2 quarters, definitely suggests that companies are hiring and they're back on the hunt to restaff, and that's really been a big help for the UK consumer and the UK jobs market. Okay,
so not completely pessimistic.
Yeah.
Some optimism there. Okay. Well, unfortunately, this is all the time that we have for today. Nevertheless, gentlemen, thank you very much for joining us. Thank you very much for your very valuable time.
Thank you.
Thank you.
And that's all from us here at Digital Look TV in London. Thank you for joining. Until next week.